things played out based on some of our thoughts as of 2023 and going into what happened last year. So we're really excited to be here with you. My name is Ali Radawalji, and I will be speaking alongside Naushad Virji. And we are both really thrilled and enthusiastic about today's topic. It is something that we feel is very relevant and pertinent to share with you all, clients and others alike. So I see some of you coming in here, and it's exciting to have you join us. So without further ado, it's a jam-packed event, and I will be covering my portion a little bit later, and Naushad Virji will kick us off with some background and also overview of the passive as well as some of the value strategies. So I will turn it to him, and inshallah look forward to having you all tune in and share any questions in the question Q&A section. So we'll try and address those towards the end as well. Thank you.
All right, Assalamu alaikum, everybody, and thank you for joining us. Ali Rado was in a very nice way trying to say age before beauty. So I guess that means I'm up first. I'm going to go ahead and share my screen, and we'll dive right in because I know time is a little bit against us here. Fatima, you'll have to just enable sharing so I can share the slideshow. Perfect. All right, so welcome to our annual report and outlook. So my name is Naushad Virji. I'm the founder of Sharia Portfolio. I'm also one of the portfolio managers here. I manage the value models and the passive models for the company, and Ali Rada, our CEO, manages the growth models. We're going to start off with a little disclaimer here. We're not giving you investment advice. We're simply giving you a presentation on some of our thoughts and opinions. For financial advice, you need to speak with one of our financial advisors in a one-on-one session where we can take into consideration your personal situation and your preferences and risk tolerance. So for our year in review, I would like to first start off with a discussion about our investment styles. Then I want to talk about the performance of our various models, and then I'll go into a brief discussion on the market, some economic insights, and then my expectations for 2025. For this first section, I'm going to go through pretty quickly as far as the investment styles. I do this every year, and most of you are probably already familiar with the fact that we're one of the very, very few firms that offers both active and passive investment strategies. Our active strategies allow our clients to really take advantage of individual stocks and personalization. So these models are made specifically tailored to your situation. We're able to focus on things like tax loss harvesting. We have quite a few different models and approaches, meaning value and growth. On the passive side, we offer passive strategies as well, which allow our clients to have more of a buy and hold approach. We focus on ETFs, or exchange traded funds. It's a type of fund that tends to be more passively managed and also a lot cheaper than a lot of mutual funds. By having a basket of stocks within these ETFs, we're basically decreasing risk by diversification. This type of strategy is more suitable for smaller investors, people who are just starting out. It's a great way to get into the market. If you have, let's say, a $500 portfolio, you can't really buy 20 stocks, but you could buy one ETF, which will give you access to hundreds of stocks within that basket of stocks. We have 6 investment strategies on the passive side. So on the active investment side, with our models, we've got 2 approaches, value and growth. So with our value strategy, we're really looking for bargains. We're focused on undervalued stocks with expectation that those prices will go up over time. This allows us to be in equities, but also keep our risk levels a little lower. This is really suitable for investors who are really focused on stability, especially over time. There's still going to be market gyrations, but they'll probably be less impacted than growth strategies. However, the growth side of our active offering allows people to prioritize higher future earnings potential. We're able to invest in strong companies that are growing very, very fast, which gives us even higher potential returns. This is suitable for investors who are more comfortable with higher risk, which means more volatility, but greater upside potential long term. Our passive models look like this. The 6 different strategies that I mentioned. Aggressive is our most aggressive, obviously. Sukuk is our focus on capital preservation, and then we have all kinds of models in between. This is something that a lot of our clients might do on their own using our ETFs or even our target date funds. The ones that come to us generally like us to handle the monthly rebalancing that we do, and also making changes based on current economic conditions. But this is effectively what our passive strategy looks like. Now I'm going to go straight into section 2, our market performance. First off, let's talk about how the markets did in general. The S&P in 2024 was up 23.4%. And you can see from the white line here, this is the performance of the S&P 500. For those who are not as familiar with that, the S&P 500 is effectively a gauge of how the market is doing. So when we're thinking about the market, oftentimes we're thinking about the S&P 500, which are the 500 biggest stocks in the market. So the white line kind of gives you that indicator of how we did, and the markets were up 23.4%. The yellow line indicates how Sharia compliant stocks in general did. So what we do is we take a look at the same thing, SPY, the S&P 500, remove any non-Sharia stocks, any stocks that are dealing in riba or haram industries, and we're left with the yellow line, which, as you can see, outperformed, although by a small amount this time, but we outperformed the SPUS Sharia index did 24.3% versus 23.4%. So it was a small outperformance, but nevertheless, it did outperform last year. Now, though the S&P 500 did fairly well and SPUS did really well, our model performance is indicated here. These are the value models of both our active strategies and our passive strategies. I have left out growth because I don't want to steal Alirada's thunder. We had phenomenal returns last year in the growth model, and I'm going to let him give you guys the good news on that. But on the value models, we did underperform in our aggressive strategy. Not too bad of a return. Our target return is 10 to 12% a year for aggressive. So we had a 15% return. So we're well above our target, but we did underperform the S&P. And there's a few reasons for that I want to discuss. But before getting into those details, you can kind of see how the other models did. Our passive strategy was up 24%. This is just last year numbers here. Our conservative funds are the passive model, our growth, etc. I'll let everyone just take a quick look at this. Our conservative model hasn't really been around for 10 years yet. So we only have the return since June 30th, 2020, when that model started. So that's why there isn't a 10-year return here yet, but all the other models do have that. Now, before I dive into the individual stocks that we were using in the models, I'm going to go through the sector allocations. Sectors are really important considerations. So it's not just about what stocks to buy, but which sectors do we want to be in. So here we're looking at what percentage of each sector is in the portfolio and how much is in the benchmark. So for our value model, we're looking at the S&P Sharia index. So the Sharia index has 10% or a little over 10% in communication, for example. We're at 2.43. So we're about almost 8% below the benchmark. Now, the reason for this is that we eliminated Google from the model, and that was our main communication stock in the past. But some of these other ones are more tactical in nature, like consumer staples. These are more defensive stocks. We're actually higher than what's in the benchmark. And same thing with energy. And also this non-classified that you see at the bottom, this is basically Sukuk and cash. So whenever you see non-classified, it's a combination of Sukuk and cash. So in our aggressive, we had about 8%, a little over 8% in Sukuk and cash at the end of the year. So as you can see, I basically focused more on a conservative side here because my thought process was that the value, from value anyway, I was finding less and less value in the market. The markets went up significantly. We reached all-time highs. And so I started positioning into a more defensive posture. So that's why you'd see more staples, you'll see more energy, more Sukuk in cash, a little bit more in real estate, and a little bit less in things like technology and in industrials and consumer discretionary. So this really explains a lot regarding how I was looking at the market and what I was trying to position for our aggressive model. For our moderate, we kind of look at the S&P 500 as our benchmark. And so when you're looking at the benchmark here, you're looking at how the S&P 500 is split up. And you can see here the non-classified now, we have over 25%. That's because of Sukuk and a little bit of cash as well. So obviously the S&P 500 is not going to have Sukuk in it, but you can at least get idea of what we're not investing in, like financials, for example, is a big one. We're never going to fill this gap because there's not as many Sharia compliant firms that we can invest in. So that's always going to be a little bit of a gaping hole until we have Sharia banks out there. However, you can see communication services and consumer discretionary were a little less. And again, I was being on the cautious side. Same thing with industrials. And then with real estate, we're higher up, and we're higher up with energy and also our Sukuk. So this is a very defensive posture. The way I'm looking at it, it's not just about making money, it's also about not losing money. Both things are important. And so I was positioning our value models to focus a little bit more on the latter. Same story here with our conservative model. You can see, here the difference between us and the benchmark is a little bit more striking. We do have a little bit more infotech than our benchmarks would. Because we don't want to be in some of these other areas like financials and utilities and other industries. So instead, we'll focus a little bit more on infotech than most other conservative models might. But this is also one of the reasons our conservative model did so well last year. It's that holding of almost 12% in technology. Now, the three stocks that really had a big impact on our value models were number one, Cal-Maine, which is the largest egg company in North America. Eggs are not usually the first thing you think of when you think of 100% return. However, Cal-Maine, since inception, we're up about a little over 100%. So if I was to show you a chart, you would think I'm looking or showing you an AI company or maybe a Tesla, graph or something. But this kind of proves that you can do pretty well with some value stocks. And Cal-Maine was really one of our top performers last year. Taiwan Semiconductor was another one. This, to me, was an obvious play. It was very cheap compared to NVIDIA, but it's still in the same business. So it was kind of like buying NVIDIA at a huge discount. This stock is also up pretty substantially. And then Encore Wire, you might remember from our previous year's presentations. Encore Wire was a stock that we did exceptionally well with. We did sell this stock last year, but it did help contribute to our returns quite a bit. So I'm going to talk about the performance distribution. So this kind of explains what worked and what didn't. So our tech ETF, which is a global technology fund, had a pretty big contribution to our return. CTR stands for contribution to return. So the total return of each of these securities is listed in this column in green, and then the ones we lost money are in red. But the contribution to return is how much our return was impacted by some of those stocks. Now, I showed you earlier that with our aggressive model anyway, we underperformed a little bit. you can see that there were really three stocks that made us underperform pretty substantially. One was TK Tankers, which is a company that transports oil. Another one was SQM, which is a lithium producer, and Amphastar Pharmaceuticals. Amphastar and SQM we eliminated from the portfolio, not just because of their non-performance, but the thesis changed. In SQM's case, the government of Chile got involved in the company and changed a lot of the dynamics of the company, and therefore was keeping a lot of the return for themselves, which really hurt the stock. This is the kind of thing that's kind of hard to imagine happening, but it happened in Chile, and that stock ended up going down 37%, which took away more than 1% of return from our model. And then TK Tankers is one that I actually feel really good about. We're still continuing to hold in 2025. It's actually performing really, really well. It's up about 18% in the last 3 months. So I'm still hopeful about this stock. It's I think reduced this return or this loss by half already. And I think it's going to still continue to do some good things this year. So these were the three things that really kind of held us back a little bit. But a lot of our winners were the ETFs, CalMain, which I mentioned earlier, which for last year, the return was 87%, Taiwan Semi, which gave us a 92% return. Salesforce gave us a 29% return, and Encore Wire was at 35%. So these are some of our top performers. I could go on and on about each of these stocks, but I know we're a little bit constrained on time. So I'm going to just move on and show you the same performance distribution for our moderate strategies. Very similar story. However, our return was pretty impressive for moderate. We didn't have as many stocks pulling us down. It was really just TK Tankers mainly, which, as I mentioned, is already coming around, and I'm not really that worried about. I think it's going to be a good holding longer term. And then for our conservative models, yet again, for a conservative model to be up around 9% is not bad. Our target return in conservative is 3 to 5%. So we kind of killed it there. So people who are really, really focused on being conservative, this is the kind of performance distribution you will have seen in your models. Now I'm going to go into the next section, which is a little discussion about the market and some of my economic insights. First of all, in 2024, we had a very strong stock market. Financial companies did really well. Technology did extremely well. Communication actually came around and did very well also. And they all brought in very large gains. A lot of that was also because inflation stabilized. Inflation was one of the most pressing concerns for the last year and a half or so. But inflation hovered around 2 to 3%. It was actually kept under control. And I think in hindsight, it seems the Federal Reserve did everything that they needed to do. And so there's less pressure on rates now. Now, it was also a big election year, which is a kind of a wild card. Political uncertainty leads to a lot of unforeseen things in the markets. As you know, Tesla really took off in the last couple of months. At least a part of that story may be Elon Musk's relationship with Donald Trump. So we'll see where things go from here. But I believe that there may be now some short-term uncertainty heading into 2025. Which now leads me to expectations about 2025. So after having a really bullish 2024, there's a growing risk for a bear market, in my opinion. Now, normally, bull markets average about 5 years. And if you look at the last 2 years, we had 2 very good bull years, and you could make the argument that, okay, maybe it'll continue on for 3 more years. That is the average. However, in my opinion, 3 years ago when the markets came down, I don't believe that was a really strong downturn, at least not compared to 2000 or 2007 or 2008. So I do believe there's going to be a little bit more of a challenging year this year. Looking at things like the Buffett indicator, we are at pretty high levels. This is very similar to the tech bubble. So if you remember what that looked like, at least to me, it feels very similar now. And so I'm going into more of a defensive posture, as you've already seen in the models. But then at the same time, I believe there's going to be a lot of opportunities coming. So as a value investor, we always get really excited when markets are down. When they're up, personally, I'm a little nervous. But when they're down, when we've had a 20% pullback, for example, for me, that's like Black Friday. So I want to take advantage of sales. I want to buy stocks. I've already got a list of stocks that I'm very interested in, and I'm just waiting for Black Friday. Now, I don't know when Black Friday is going to be. It could be in the next few months. It could be in the next 12 months. It could be next year. I don't know when it's going to happen, but I do believe there's going to be a pullback. And when that happens, it'll create a lot of opportunities for a value investor. Current valuations have reached extreme levels, so I think lower future returns could be a catalyst, but we'll see. What is our response, or what is my response as the person managing the value models? First of all, to reduce risk, you can diversify more thoroughly. And the easiest way to do that is to move more money into the ETFs. And so that's one of the things you might have noticed in the last few months. We have positioned a little more in ETFs than we normally would. I'm also very interested in investing beyond the domestic market. You've already seen that with Taiwan Semi. We took a much larger position in SPWO, which is an international market index, which gives us exposure to a lot of developed and developing world markets. And then we also have our share of defensive stocks like Cal-Maine and Toll Brothers, et cetera, which help reduce the risk profile of the portfolio. Now, one of the questions you might be thinking, well, if I'm expecting a 10 or 20% drop in the market, what am I going to do about that when it happens? So I've already outlined what I'm doing now to try and protect the portfolios. But the response to a downturn for me is to do the exact opposite of these things that I just mentioned. So instead of buying ETFs, I would want to sell some of our ETFs and move into individual stocks. I might move away from international and back into domestic. And I would certainly want to reduce what we have in our defensive stock positions and go a little bit more aggressive. So it's basically the exact opposite. If we get this 10 or 20% drop. So a drop like that will allow me to time my purchasing to buy some true value. So it really is a Black Friday strategy. The only difference is I don't know which day Black Friday is going to be this year, but I'll be on the lookout for value stocks. Anyone who is in our value models, feel free to reach out to me if you want more detail or want to discuss your model or the model, or have any questions or concerns, or reach out to your advisor. But I want to just take a minute to thank you for joining us today and for investing in the value models. With that, I'll turn it over to Ali Radha, and he can talk to you more about growth. Go ahead, Ali Radha.
Thank you so much, Nishad, for that introduction and for providing color as to how things played out within the value as well as passive strategy camp, and some of the thoughts about the planning going forward. So I will jump right in to get the ball rolling with regards to the growth strategies. Let me make sure I have the slide ready here, and I'm at number 22 there. Okay. Nishad, let me know if it looks good. Full screen mode.
Yeah, it looks fantastic.
All right, perfect. So I will cover these four main themes for today. How did we do last year? What is our thought process for 2025? I like to talk a little bit about the macro environment because I do believe that does give a little bit of idea as to what to expect and how to position based on the conditions that we find ourselves in. Just like if it's raining, you might want to slow down. If it's snowing and you're driving, I just drove from the Midwest back to Florida. If it's snowing and icy, you want to change the driving style. So based on that, I think it does influence how we should operate. So in 2024, the NASDAQ, of course, considering I'm talking about the growth strategies, I will focus on speaking a little bit about the NASDAQ as our benchmark. It was up around 24.9%. A lot of that was driven by AI. And, in general, it had its second best year after, in the last 25 years. So it was a pretty fantastic year for some of the growth strategies. And we'll talk about where some of the opportunities lie as we go forward. So in terms of the growth versus value, and this is just a healthy exercise to see how growth stacks up against value. So when you look at the delta, which is the difference between growth versus value, was about 19% last year. And in 2023, it was 31%. So we've had a pretty good time. And, it doesn't always happen. The prior 2-year outperformance in the history based on the data here was in 1998 and 1999. So, it may continue, it may not, but this is just something to keep in mind as we try and examine how things played out last year. This is how our strategies performed, and keep in mind this is a composite of all this, accounts in a particular strategy. Any individual client's performance might vary based on various conditions, but last year our aggressive was up 89.5%, and these are net returns that we're looking at. Our growth, which is the middle tier that we have, was up 73.9%. The moderate was 63%. So in relation to the S&P or even the NASDAQ, alhamdulillah, we did quite well. So we don't have a 5-year history yet for the growth strategies. These came about a little bit later as a way to allow our clients to benefit from an expanded menu, just like I'd like to talk about spicy food, right? If you go to a restaurant and you might enjoy spicy food, not everybody will like the same flavor. I like level 10 for those who know me, and some may prefer a little bit bland. So that's kind of how you can think a little bit about the growth. It does carry a lot more volatility, but the average annual return since we began the growth strategies for the aggressive is close to 18%. And similarly, it does tend to differ for the growth because it just depends on the time frame. But alhamdulillah, this is what we have achieved, and we hope we can keep up as we go forward. And this is what I was trying to mention earlier. Last 2 years, the index has done quite well. And since beginning of 2023, the index has returned 84.5%. So it's been a fantastic 2-year for the NASDAQ and growth camp in particular. I like to also look at this scorecard because this does give perspective on how the different asset classes performed, and not just for last year, but over a 10-year time frame, because I think that tends to give a better color as to how things are moving. Bitcoin in particular has been, on the spotlight more recently, but has also done quite well historically from what we've seen. With the advent of the ETFs and the popularization of this theme by the corporate treasuries, as well as nation states talking about strategic Bitcoin reserves, among other things. This will be a front and center topic for many, many years to come, I believe. And we have seen that it has been producing quite substantial returns compared to other asset classes. So I think it's very relevant and something that we will have to keep an eye on. Our growth stocks also did well. The gold was one of the asset classes that did quite well. And I like to look at Bitcoin, which is also seen as in the mainstream now as digital gold. And so if gold does tend to do well, we've seen historically Bitcoin also does well. Although there has been drawdowns, 3 drawdowns that we've seen, the average annual return still gravitates close to 147%, as you can see here. There has been some challenges in the bond market space, and I will talk about that in the next slides. But this is just something to give a perspective on how the different categories have been doing. So you can feel free to reference this. Bond markets have been in a drawdown for the past 53 months. So this is on some level scary, on some level not entirely unexpected, because I think a lot of the problems associated with the bond market have to do with the debt problems that we are seeing in the US and abroad as well. And it's starting to cause a lot of question from the investors' minds, right? How much value or how much of a role bonds are playing in a portfolio, and if we should be rethinking some of that. So just want to share the data as to what has been playing out. And in terms of the S&P 500, over time, historically, the higher percentage allocation used to be in the oil and gas sectors, because that is what was powering the a lot of the revolutions, industrial or otherwise. But as time has progressed, the advent of technology and innovation has been much more front and center. We all have, the ability to conduct this webinar online and have people join in from all over because of the benefits of technology. And similarly, I think that it's going to continue shaping the way we live and operate for the next few years as well. So it's not surprising that innovation is taking a higher chunk of what the composition is within the S&P. And I think that we will likely see more of that as we go forward as well. This is something that I think is really helpful to visualize, because a lot of people, when they measure their return, they may not necessarily be looking at it in relation to inflation. So if you've heard me in the past, I've mentioned, if you kept money in the 1990s, if you had $100,000 and you kept it under your blanket, right, somewhere, hopefully not, but if you did, it would have declined by over 54% in value as of today. And that's just because of inflation. But let's say you invested that, right? The S&P would have returned a higher return, and that's what people would have assumed. They made a 65x return, but in reality, if you adjust that return for inflation, because obviously inflation erodes the purchasing power of your earnings or your money, then you would have essentially only achieved a 6x return over the last 60 years. So something definitely eye-opening and irrelevant for us to keep in mind, especially in a world where inflation is continuing to affect people's lives. In terms of the individual stocks, I will talk about a few names that helped us and also where we see a lot of value, even though they've done quite well. NVIDIA being, of course, a name that had a lot to do with what has catapulted the S&P to the 25% return that we saw last year. NVIDIA played majority of the role. So we can see it was up 171% last year, and it definitely contributed 22% of that 25% return that we got in the S&P came from one stock. So, NVIDIA is continuing to do what NVIDIA does, innovate, produce a lot of amazing products like the Blackwell chips that are about to be released. I think the market share in the data center is eclipsing any other player out there. AMD has about 8% share, if I'm not mistaken. NVIDIA commands a 90% share. So, clearly the last 5, 10, 15, 20 years, NVIDIA has been the best performing stock in the S&P 500. And I see this continuing to still play out as we go forward, especially as AI continues to be relevant and front and center in the world that we are operating in. One theme I will mention is, a lot of people wonder when is a good time to exit NVIDIA, or should we get out and try and get back in. So one thing to keep in mind, and this is a lesson by Peter Lynch, if any of you have ever heard of him, feel free to check him out. He's been a legend in the investment world. And he actually cited one important sentence, or one line from him, is that selling your winners and holding your losers essentially is like cutting the flowers and watering the weeds. So if NVIDIA is winning, then I find it that yes, we can take profits along the way, but I don't see necessarily a reason to exit especially as the growth is still continuing to continue to play out. So that's something to keep in mind. We also had benefited from MicroStrategy last year. MicroStrategy actually also outperformed NVIDIA. And it is a more volatile stock, but the top chart shows the performance, the bottom shows the Sharpe ratio. And what is the Sharpe ratio? It's basically a measure that shows how much risk you're taking in relation to the return. So a higher Sharpe ratio, especially anything above 1, indicates a more favorable risk reward. So MicroStrategy, for example, has a high Sharpe ratio, but it also is commensurate with the return that we are getting by holding this stock. And today actually was a pretty good day for MicroStrategy as well. We'll talk a little bit about Tesla. This is a name that you've probably heard me speak about in the category of looking at the cash flows in relation to the other pure EV players. Tesla is clearly in a league of its own. And a lot of people still don't fully realize what Tesla is all about. People will often compare it to Toyota or other car company, but in reality it is an AI stock, the way I look at it, and others are now slowly catching on to this as well. But if you look at the S curves on the right here, EVs is one aspect, but full self-driving, autonomous robotaxis are things that are going to be happening in our near future. Energy storage, mega packs, and robotics is going to be the other areas that are going to produce much bigger revenues for this company, and of course transforming the world as we see it. NVIDIA CEO recently spoke at the CES conference, and he's basically expecting or providing the pathway as to where the world is moving towards. And so AI has been evolving, and he believes the apex or the most biggest value for what AI is going to produce will be the physical AI space, which is self-driving cars and robotics, both of which Tesla is at the forefront of. So I do believe that'll be an important area to watch. And we've already started to see Tesla kind of waking up. Today was another amazing day for that stock. So it'll be something worth keeping an eye on as we go forward. So where is 2025 going to go? I think it's a question a lot of people have on their minds. From some of the comments here that we've seen from advisors at other firms, they've mentioned that, look, if 2023 and 24 have been pretty much textbook for the first 2 years of a bull market, because others see this bull market as having begun around October 2022. And historically, bull markets tend to last over 2,000 days. Then it is reasonable to expect that third year will also continue to play out as is. And a lot of majority of institutions are forecasting 10 to 15% returns for the S&P in 2025. So we will see how that plays out. And a lot of that, of course, comes down to the earnings. And we'll look at what are the earning expectations as well. But this is another chart that basically says that on average, since 1950, your average S&P, 72% of the time, S&P produces a 9.5% return. But after a 20% gain, that return is 81% of the time you get a 10.6% return for that time frame. However, after back-to-back 20% gains, again, we're looking at it historically. It doesn't mean this is what's going to play out, but they're saying 100% of the time, you can see a 20% gain from that time frame. So I think that it is data that we can look at from a historical context, but on the ground we'll have to monitor and adjust our strategies as we go. But this is at least gives some level of confidence that there is expected, hopefully, good things to come if this does hold true. In terms of the opportunities, I think that the winners for the next cycle may not necessarily be the same as the prior cycle. Expectation is that maybe the small caps might be where we see better value, and clearly they're trading at a much better valuation. So not only are they attractively valued compared to the large cap, when you look at the S&P small cap index in relation to the S&P 500, but also the earnings per share growth is expected to be higher. So when growth is there on top of a better valuation, I think that could mean good things happening in the small cap space. With regards to the crypto space, I know a lot of people are curious or interested or just trying to understand a little bit better what's going on. Well, since the approval of the ETFs, we can see this is what's really contributed to the charts looking different compared to the prior cycles. Once the ETFs came about, it has attracted a lot of money into this space. And specifically, when you look at the Bitcoin IBIT ETF, the BlackRock ETF for Bitcoin, you can see that it took over 20 years to reach 33 billion for their gold ETF, but in 1 year they were able to amass over $57 billion in their Bitcoin ETF. So this not only speaks to the money that is coming into this space, but also the appetite that people have for this asset class. And I think part of it has to do with the debt problems that we have. Part of it has to do with the performance that people are looking for. So the next phase we'll talk about is the themes and some of the expectations. So I think that a lot of people curious, is the U.S. market, is it getting overvalued? Is it getting out of hand? I like to look at how is the market doing in relation to the earnings. So if the market is rising, but also the earnings are rising, then I think that's a healthy thing to see. And in relation to the MSCI World Index or any other emerging markets or developing markets, indices out there, you'll see that they have not done as well performance-wise, but part of that also has to do with the earnings hasn't been as strong. So when you see America and the US markets doing well, a lot of that has to, is being supported by the earnings side of the equation. Also, European stocks, we can see they're getting decimated, and part of that also has to do, their share in the global market has been declining. US share has been increasing, claiming close to 50% on the US side. And I think that this underperformance is not, I think part of that is due to the regulations that the European economies tend to have. We've seen that if they do not eliminate some of the chokehold on the growth, because too much regulation sometimes stifles growth and innovation, and I think Europe is mired in a lot of that, and that is probably affecting investment in that space. So unless some of that turns around, I think it's not looking very bright in some of the European equities. So this is something that Bespoke has shared, and it's a macro research house, and they have given some of the pros and cons. So I've shared some of the things that could support growth, but I will talk a little bit about valuations. Of course, we'll have to watch, as Naushad mentioned, when you look at the Buffett indicator. We've also seen the housing market not doing so well. Mortgage rates hovering over 7% on the 30-year. Mortgage demand at an all-time lows. When you're looking at the last 30 or 40 years, it's hovering at the low points. When looking at the affordability, that's a problem for a lot of people, especially when the median household income needed to afford a home is close to 120,000, but a lot of people may be at the 80,000 mark as their average income for families. So there's clearly a disconnect somewhere there, and I think housing market will go through a little bit of trouble in the short term, but long term, real estate is still a relative and important place for a lot of people to park their money and grow and earn the rental income and such. But in terms of the Fed, a lot of people are concerned. Were they taking off the foot too early in terms of cutting rates? Are they going to reduce the number of cuts that are coming? I personally see that following especially today's inflation numbers, the cooling of the core inflation has brought back, today was pretty much one of the best days in the market since November. And a lot of that has to do with the cooling inflation. So if inflation is showing signs of cooling, then, folks have less to worry about from the Fed having to cut rates, because, we're still in an easing cycle. Even if they may delay how many cuts they do this year and push those out, I think that relatively speaking, reduced rates should be positive for the economy. On the positive side, of course, we're seeing labor markets healthy. We're seeing that the sentiment has been a little bit bearish, and that usually is a contrarian indicator. When there's a little bit more fear out there, I look at that as a good time, right? As Buffett says, be greedy when others are fearful. We're still in early stages, I believe, of the bull market, and especially AI. So we'll see how things play out, but these are some of the pros and cons that are here listed for your reference. This is what I was referring to. We're seeing fear still at, we're still in the fear zone. When we get to extreme greed, that is usually when we will be looking at trimming and locking some of those gains. But I think that there could still be some opportunities as fear is still prevalent out there in the sentiment. This is what Fundstrat has shared. So they believe the first half of the S&P 500 for the first half of 2025 will be positive and could reach even 7,000. But they are expecting some weakness in the second half. And part of the weakness they feel could come from the efficiency measures that are going to be coming in, if there are spending cuts and things like that, or what effects the tariffs might have. And I know a lot of people are also wondering, what the new administration coming in, how that might affect the markets. I think that there are two ways, the new administration might help with the markets. On the one hand, deregulation is seen as positive for growth because, again, as I mentioned, in the European markets, the stifling of growth due to over regulation or bureaucracy really does affect how things play out. So if we get a little bit more deregulation, I think that'll be positive. On top of that, if taxes do come down, or especially even if it doesn't play out, but the expectation of taxes coming down, I think that should boost confidence and growth in the US economy. At the same time, I do think that we could see that there is earnings expansion if the growth continues to play out. And so these are some of the themes they feel will be positive for where 2025 goes and areas that could do well. This is a couple of things you've heard me talk about, the US, and it's not just a US problem. This is a problem in many other economies out there where the debt has become part and parcel of how things are operating, right? It took over 200 years to reach 12 trillion, but that quickly reached since COVID began. The money printing that ensued and so on have brought the debt levels, another 12 trillion has been added. So we're sitting at 36 point some trillion right now, and I think it's clearly unsustainable. The interest expense could reach 25% of the tax revenue. So you can imagine, your taxes and my taxes are going to the government. A lot of that has to be spent for infrastructure, defense, among other things. But we're clearly at the point where instead of using it for paying for services and things that the Americans need, it's going to be used to pay the interest expense because of all the debt problems. And so clearly that's also what's causing some of the issues in the bond market, as I mentioned earlier. And investors are looking at alternative places to park their money because treasuries, especially if yields do come down, will not be as favorable for people who are sitting in money market funds and cash equivalents. So just something to keep in mind. The interest is something that we'll have to watch, and if things get out of hand, people are looking at alternative places and hard assets to protect their purchasing power as well. So, is this bull market over? That's a lot of people are asking or curious. According to Bank of America research, they're basically showing that, look, S&P will be entering the 12th year of the secular bull market, and they're calling the start at April 2013. And if this does play out, they historically say it lasts 16 to 20 years. That means the bull market could continue up until 2029 to onwards. So I think that it's possible that we see this to be in the middle to late stages, but still in the bull market. We have seen that historically the bull markets tend to be longer in duration and bigger in magnitude in terms of the return. So even if we do encounter dips, I think a lot of those will get bought up. And there's also a dynamic shift, a generational, change that's happening with folks transitioning, the baby boomers retiring, and so on. I think there will be wealth transfer of over 68 to 72 trillion moving between the hands of the boomers into the millennials and other cohorts. And that money will inevitably come back into the market. So I think that can support more growth as we go forward. One important thing that I can mention that I think is very important to keep in mind, right? So according to data going from January 2003 till December 2022, so we're looking at about 20 years of history here. If you had missed the 10 best days, right? By missing just the 10 best days, which obviously tend to happen in a bear market, you would be missing out on majority of the returns. So this is why I often will caution investors who want to be on the sidelines or who want to keep cash, a higher percentage of cash on the sidelines. It's good to have cash because, as Naushad mentioned, right, how are you going to be able to take advantage of Thanksgiving sales and shopping if there is a deal out there? But at the same time, if you sit out too long or if you're waiting to time things too much, you may miss out on the 10 best days. And today, for example, was another fantastic day for the S&P since November. So if people were out of the markets and missed today, they would have missed out on almost 2% gain that the S&P 500 had today alone. So just something to keep in mind. So in conclusion, I think that we could expect consumer cyclical stocks to do well, especially as the economy does continue expanding and the confidence increases, which could benefit sectors like automotive, travel, or luxury goods. This could be an area to watch. Small caps, as I mentioned earlier, relative to large caps, based on higher earnings per share growth as well as better valuations, could offer better opportunities and upside potential in 2025. AI, of course, is still in a multi-year transition phase, and these are some of the areas that can continue to benefit. And then blockchain and Bitcoin, of course, this is not for everyone. For those who believe in this space and who are okay with some of the volatility, as you've seen, it can be quite volatile. It has risen to 100K today. Actually, we saw it hit 100K once again. And with the global adoption and favorable, administration policies around this topic, I think we could see this Bitcoin rising to even 200,000 this year. And as I mentioned, one of the points was, there's 6.7 trillion, maybe even more in money market funds. And a lot of those with lower yields, will not be as attractive to investors. And we believe that some of this could shift back into equities, where investors looking at how the S&P 500 has performed may be more likely to consider that as a place to park some of this cash and money market funds. So I think 2025 will be an interesting year to watch how it unfolds. We're here to navigate it with you along every step of the way. And we're excited to serve you in your investment journey. If there's any new people here, feel free to schedule an appointment with one of our advisors. And for any of you who are existing clients, we really do appreciate you joining us for this session. So I will pause there and see if you have any questions for us at this stage. I'm sure Naushad's been answering some of those in the chat.
Yeah, I answered quite a few questions that came. I think there were 14 in total.
Perfect. So how should a beginner begin investing an investment portfolio in 2025? This is from one of the YouTube questions that came in. Naushad, do you want to tackle that one?
I believe a really good way to get started is using a passive strategy. That's what we recommend to a lot of clients who are just starting. So if this is your first time investing, passive model makes it very easy. This is something you can do on your own. You can buy a target date fund. We have Sharia compliant target date funds, or you can just buy a few of the different ETFs that are available in the market. But it's a really good way to get started. And then as you get a little bit more sophisticated over time and you want to take advantage of opportunities like some of the things Alirada talked about, then you can take a portion of your portfolio and go a little bit more aggressive. So that's my 2 cents worth.
Thank you, Nishad. Any other questions?
There's a question related to target date funds and when will our target date funds be available on Merrill Lynch? This is something we're actively working on. We already have them available on a lot of different platforms. Merrill Lynch is not one of them yet, but inshallah, we hope to get that done hopefully by summer is my goal. But it's just a long, arduous process, but we do already have it available in a lot of places, including Sharia portfolio. So people who just want the target date funds, you can actually open an account at Sharia portfolio with no cost and just buy the target date funds as you want. It's a non-discretionary account that you can manage yourself and it doesn't cost you anything to do it. So that's a really good option for people who would like to get into it right now. How much do you charge for buying and selling is another question. We actually don't charge anything for buying and selling securities. We have a management fee based on what we're doing. If we're just focused on handling a passive account for you, then we just charge 0.5% per year. And we'll do all the monthly rebalancing and tactical changes as needed based on economic conditions. If it's an active model, then we charge anywhere between 1% and 1.5%, depending on the size of your portfolio. Other, maybe you can take this one. When is a good time in 2025 for one to change their risk tolerance?
All right, I've responded this actually directly by
okay.
it.
You're already in.
Accredited investors are those who either have an income of over 200,000 individually, joint of 300,000, or have a net worth of 1 million, maybe 1.1 million now with the new regulation that excludes their primary residence. So hopefully that helps. For 70-year-old, what will be your strategy? It should be aggressive or passive or something in between. So I think for each person in particular, it depends on their risk profile, their personal goals, their objective, their time frame, and their preference. So I think that to answer that, it will depend on each particular person. We have individuals who might be younger but want to be conservative, and we might have older people who want to be aggressive, although that might not be the norm, but it just depends on individual by individual. So the best way to analyze or understand what is best for you is to reach out to an advisor to be able to discuss that.
There's a question about Islamic finance in Canada and if there's upcoming job opportunities. The answer is absolutely yes. We have our company in Canada called Sharia Portfolio Canada that's based out of Toronto, but currently doing business in 4 of the different provinces in Canada and expecting to expand to 2 more this year. So if you are interested in joining the team, please reach out to the Canadian company, shariaportfolio.ca. If you go to the website, you can contact us there, and we'll just need your cover letter and resume, and we'll send it to the right person. And inshallah, maybe you can join our team.
Will SP create a Bitcoin ETF similar to IBIT? I don't know if we're working on that, but Nashad, maybe you want to comment.
I can take that question because I do run the SP funds business. Right. We actually have a bank that's asked us for this, and they told us, we weren't intending to do this initially, but we have a bank that's telling us if we do it, they'll give us 100 million in AUM. So that has actually got us a little bit more interested in it. So we're considering it. I can't say for sure that we're going to do it yet, but there are some discussions on the topic.
All right.
There's a question about the target date funds and what their definition is, and are these available on E-Trade or Fidelity? Well, first of all, a target date fund is a fund that basically that invests in our passive strategies, and it starts from aggressive, and over time it becomes more and more and more conservative. So you're starting aggressive, then you go into growth, then you go into moderate, income, conservative, and then Sukuk. So it's basically an automated process. So a lot of people who want to do their own investing or just want to kind of set it and forget it, buy one fund and not worry about changing between funds over time. It will actually do the whole process for you. These are really, really ideal for retirement accounts like 401k plans. So it is our goal to get them into as many 401ks as we can. A lot of 401ks already have these funds available, particularly if they are through Broadridge. Broadridge is the back end for a lot of 401k plans. So if your 401k is using Broadridge in the back end, then it's very likely you already have the target date funds available to you. The ticker symbols is incidentally, for those that don't know, it's SPTAX, SPTBX, and SPTCX. So that's the 2030 target date fund, the 2040, and the 2050. So you just choose the year that's closest to your target. So for example, if you're planning to go for Hajj, for example, somewhere around 2030, then you buy the 2030 target date fund. If you're saving up for a house and hope to buy a house or sometime around 2040, then you use that target date fund. If you think you're going to retire around 2050, or maybe that's when your kids are going to college, then you buy the 2050 target date fund. What is the minimum required to invest in target date funds? There actually isn't a minimum. You could buy one share, $20. So I guess $20 would be your minimum, but there really isn't a minimum. You can keep it for as long as you want. There's no fixed time period. Because it's a target date fund and it's focused on a particular year, you're probably going to want to keep it for longer term until you get to the target date. Otherwise, you might as well just buy the ETFs directly yourself. So I would recommend holding them longer, but there's no requirement to hold it long term. You could buy it today and sell it tomorrow if you wanted to. I have a question here about an income dividend fund. This is actually the number one question we get from SP funds. I think this is the third time someone's asked this just today. So I'm kind of excited because this is something we've been wanting to do. And inshallah, I'm hoping to launch a higher dividend equity fund later this year, inshallah. So stay tuned. Make sure you sign up for our newsletter at sp-funds.com. And you'll be informed when we do get to that point. But yeah, this is definitely one that a lot of people have been asking about. So thank you for that question. There's a question about, is the fees charged twice for the TDF, for the fund, and for the underlying ETF? We charge 30 basis points for constructing the target date fund. That's actually less than our costs. So we're not doing this to make money. We're doing it to make it more convenient for our clients. There is an underlying fee for the ETF, so that's where we make our money. So the SPUS ETF has a 45 basis point charge. SPSK and SPRE are 50 basis points. And then SPTE and SPWO are 55 basis points. So those are the charges for the funds. There's a question here. What is your most conservative fund? If you're talking about the models, we have a Sukuk model, and the goal of that is for capital preservation. So people who, let's say you have an emergency fund, that would probably be a good type of strategy to use for that. The goal there is not really to make a ton of money, it's to focus on capital preservation. So it's invested primarily in Sukuk. So that's really our most conservative strategy. If you mean what is our most conservative ETF, that's probably going to be SPSK, which is our Sukuk ETF. Another comment here about the target date funds on our website. You don't see it among the ETFs. It's actually in a separate section for mutual funds, because target date funds are technically mutual funds. So if you go to the mutual fund section of our website, you'll see the target date funds there. There's a question here, any real estate ETF with no debt-based investment? Well, we have a private real estate fund that has zero debt. It's all equity fund. If you're an accredited investor and if you want more information, please contact any of our advisors. They can talk to you about that and tell you more. What is your total portfolio offering? I'm not sure what the question is referring to. If you're asking how much are we managing, I think we currently manage 1.8 billion in assets. But yeah, that's the total AUM for all of our whole company. Alireza, are the fires in LA affecting our investment returns? I'll let you take that.
You needed a break there, Nashad. You've been on the roll. So I think there is some, we'll have to watch. I think it'll definitely affect insurance companies for sure, because I mean, they have over 200 billion plus, I think, damages there. But more important things that affects the market is generally what is going on with inflation, what is expected, things around the rates, because that's what really drives the economy, based on where we are. And so I would be more concerned if we were seeing a change on those things. Although, of course, this is a problem, people will have to relocate, and we feel very, sorry for those that are affected and their families. But so far, I have not seen any massive effect on our strategies, primarily because we also don't have exposure to the, insurance space. So hope that helps. But of course, how it will play out down the line, if there'll be downstream issues to watch out, we'll keep an eye out. Looks like we've pretty much tackled most, if not all.
There's another question about the target date fund and if it's available on E-Trade or Fidelity. We are in talks with Fidelity now. So inshallah, that'll be hopefully in a few months. They usually take a few months. E-Trade, I believe, is owned by Merrill Lynch now. So whenever we finish our discussion with Merrill Lynch, then it should be available on E-Trade as well, most likely this summer. There's a question about tax implications. You want to take this one earlier?
Yeah. So if you're selling in a brokerage account, you obviously want to be mindful of taxes. So a lot of, especially last year, was a primary example of how to be careful with taxes, because we were up over 80% on our aggressive strategies, as you saw. So if we were to sell and realize a lot of those gains, it can affect the tax situation by, within the 1099 that gets issued. So one of the things we try and do, of course, if possible, is to offset any gains with losses. This is something called tax loss harvesting. If there are any securities that did so well and we were able to realize the gain, then we try and look for, especially in Q4 of any given year, we try and look for, are there any holdings that did not do so well that we could potentially sell to offset the gain so that you don't get hit with a big tax bill. But this can also happen when you're changing a strategy or rebalancing. So when we are rebalancing, we're obviously mindful of that. But if you are changing the strategy, and I know one of the persons was asking that, if it's a taxable account, I like to call it, like when people transfer, for example, from other places, I always say, look, we'll do the surgery gradually. We don't want to do a massive surgery at one time where you have to change everything at the same time, because of course we want to be mindful of the tax implications. So we have to keep in mind all the different perspectives, and so your advisor that you're working with can definitely work with you on how to best navigate that. And for those who are also asking about the crypto side, we do, aside from the real estate fund, one of our private fund offerings is a private investment in the digital asset space. Again, this is for accredited investors only. So anyone here who is interested in learning more about that, you're welcome to reach out and we can provide more information about that. So just wanted to throw that out there. And yes, investing in the Fidelity crypto ETF is considered halal. But again, these things can change because we checked with our Sharia advisor and he was able to verify this for us. But things evolve and can change, so we want to keep an eye out for these things as we go forward. But as I said, there are other ways to get exposure to the crypto space. I did talk about some of our growth strategies, having exposure to that. But beyond that, there is private equity type offerings as well for accredited investors. So if that is something that you find interesting or would like more information on, you're welcome to reach out. With that, I think we're pretty much close to 1 hour, 15 minutes here. We really do appreciate you guys joining us. We found that by keeping it concise, hopefully we were able to impart relevant information, whether you're a new investor or a seasoned investor. Hopefully you are able to take away some nuggets from our session today. We would love to hear from you. If there's any feedback that you have for us for future sessions, let us know. If there are topics that you're interested in or things you would have liked to see on our future webinars pertaining to the year-end review and outlook, do let us know so we can try and incorporate some of that. But we really pray that everyone is healthy, safe in this new year. And we pray for a successful 2025. And would love to continue working with you all in your investment journeys respectively. So thank you once again. Thank you, Nashad, for your time. And hope you all have a wonderful evening.
All right, fantastic. Thank you, everyone. Assalamu alaikum.